What do you think about what's going on right now with the US effectively saying they're going to adopt stablecoins to propagate dollar dominance? Should other nations with currencies like the Eurozone with the Euro be worried about this?
Eurozone should be worried because if US treasuries get more accessible, anybody that invests in government bonds, better access to US debt, which generally gives a higher yield, they would go for that, and that would be at the expense of European debt. It's a misplaced conception that stablecoins are going to cut out the banks, because you actually don't want to cut out the banks. You want to team up with them, because together you're stronger. We can do things on top of the banks, where the banks still capture transaction fee revenue, and we can deal with some of the customer-facing work and the innovation. So it's actually quite a nice symbiosis. So what stablecoins bring is finally decoupling at a global scale money from the underlying banking rails from SWIFT and making it universally accessible. It's like handing over your bank account to the secondary markets. You're not really relying on the bank anymore to give you on the bank's ATM. You just use the markets as your ATM and take money from where you want it. Stablecoins are being increasingly recognized as a highly disruptive ingredient in treasury management. Most stablecoins may live only shortly. The ones that live longer are indeed in the crypto markets. And USDT is king globally. Nothing comes close.
Welcome back, ladies and gentlemen, to the All in Crypto podcast. I am your host, Rupert, and today I am delighted to be welcoming back on the show the CEO of Quantoz, Arnound Busman. Arnound, how are you?
Very good. Very good. Thanks for having me back here.
It's a pleasure. It's really nice to see you again, and certainly nice to talk to you about such an important topic, which is stablecoins, the kind of bringing on-chain of money and that whole world, which is increasingly going to become a part of our world. So I think where I want to start is some of our viewers and listeners may not be familiar with what it is you guys do. So maybe you could give us a quick overview of Quantoz.
Sure. So Quantis, we are a fintech. We're based in the Netherlands, regulated in the Netherlands by the Dutch Central Bank. And we are offering corporates and platforms, marketplace, etc., that do business in the EU with instant 24/7, 365 payment settlement capability globally, so cross-border, wherever you are in the world. We basically give companies access to payment rails and treasury solutions in the EU. Now, this is in contrast to existing payment rails, which tend to go via SWIFT and which can take a while and can be expensive. We add two new layers on top of that infrastructure. One of them is at the e-money, in the form of e-money, just like you see with neobanks, for instance. And the other one is through stablecoins, which puts that e-money concept on steroids. Maybe to give you an example, if a Hong Kong merchant that we're working with has customers in the EU, they want those customers to pay them in euros, and these are relatively small transactions. That doesn't really work if you do that always via SWIFT. And so we, as an EMI, can help them collect those payments from their customers and put them in their account with us. And our Hong Kong merchants client can instantly mint that money into a stable coin, which they move back home to Hong Kong and offer them there. So it essentially gives internationally operating companies access to payment solutions in the EU with the speed of SEPA.
Wow, kind of like a Revolut for corporations. I mean, that's truly interesting. And I think this is why I love having you on, is because you clearly see where money movement is going and how technologies are enabling that. What's the big kind of thing going on here with stablecoins? You know, we talk about e-money and people are familiar with e-money, electronic money. But stablecoins have brought something perhaps new to the table. What do you think the big kind of overview is here in regards to what's happening with stablecoins? Is it the natural progression of money, perhaps eventually? I know we're a while off of that. What's the big overview in regards to stablecoins and the unlock taking place here?
I think stablecoins are a next iteration of e-money, if you think about it. E-money is a form of digital money that was invented to decouple, let's say, the movement of money from the banking system. So if you've got two users of your e-money as an EMI, let's say you're like your example, both of you are Revolut customers. You move money to each other. The money never leaves the underlying bank. It stays in the same omnibus account. But the allocation, it changes through an internal booking. Instantly, frictionless for free. That was e-money, and that's working well. Stablecoins, in the EU, we call them e-money tokens. They actually they take e-money to a next level, which is into secondary markets. The classic e-money lives in the primary market. You issue it, you move it to somebody else that the issuer knows, and then you turn it back into normal money. With stablecoins, you issue it, it goes off to an exchange, go into any kind of wallet anywhere in the world, and live there for a while before it comes back to you. Now that enables cross-border payments, that enables much more liquidity and optionality for payments, and also options in terms of the rails that you could use. So what stablecoins bring is finally decoupling at a global scale money from the underlying banking rails from SWIFT and making it universally accessible. For instance, if you want to transact in US dollars in a country and you don't have access to correspondent banking as a bank, you don't have access to SWIFT network, you can have access to US dollar stablecoins, and you still can complete your get paid and settled. Right? So suddenly, it's like handing over your bank account to the secondary markets. You're not really relying on the bank anymore to give you on the bank's ATM. You just use the markets as your ATM and take money from where you want it. It's
yeah, we're kind of seeing the democratization of money. I think we're seeing perhaps a move away from the legacy system, which seems to be fighting back. I know Swift, for example, they announced their ledger of ledgers, as it were, and that's under development or is going to be under development. I think they've got a lot of work to do on that. And this space moves so fast, just like with a digital euro. You know, you just spoke about e-money versus stablecoins. Digital euro could be classed as e-money and stablecoins. I know we're going to get into this, but they're looking at rolling that out in 2029. If you think about where this space is going to have gone by then, it could be totally different and a different landscape that may not fit that digital euro. I know we'll get into that a little bit later on. Talking about the US dollar,
yeah.
What do you think about what's going on right now with the US effectively saying they're going to adopt stablecoins to propagate dollar dominance and also introduce a purchaser to their treasury market to help with them sort of more economically? What do you think about what's happening here? And should other nations with currencies like the Eurozone with the euro be worried about this?
It's an interesting one, right? So I think Eurozone should be worried because if US treasuries get more accessible in one form or another, then obviously anybody that invests in government bonds, if they got better access to US debt, which generally gives a higher yield, they would go for that, and it would be at the expense of European debt. So I think on the capital market side, I think there should be a concern. From a payment side, I don't see the euro is not used as a payment currency anywhere outside of the EU, and the Eurozone in the EU as particular. So that's not going to change. And I also don't see US dollars becoming a universally accepted payment currency in the Eurozone. It doesn't make sense to me. Culturally, institutionally, cost-wise, it just absolutely makes no sense. So in that regards, I think that's a little bit overblown, to be honest. Any concerns there? A shift to a euro globally would be, in terms of stable coins, I can see it happening in a number of ways. One of them is because there's in general a geopolitical shift to the euro from the US dollar. Many countries are looking to strategically decouple or reduce the dependency on US dollars. So that's one angle. But it has nothing to do with stablecoins. That would happen any other way. What stablecoins do bring, though, euro stablecoins, is potentially make it easier to facilitate that shift, because they're easier to access. You can access them outside. You don't have to be connected to the SEPA system to access euros, for instance, if they're in stablecoin form. I do see that corporate treasuries, as corporates start adopting stablecoins in their treasury mix, they will also look for ways that they can increase the capital efficiency of their cash holdings. And what's moving quite quickly is tokenized yield products. And if you can access them, access yields whilst retaining the liquidity of cash, that's a killer use case for treasuries. And given that most of these treasuries are denominated in euros, you could expect them to use stable coins to access euro.
Treasuries.
So the treasuries are in euros, yes, and they'll use euro stable coins to access those euro-denominated yield instruments. The fourth reason I can think of is that globally, I think FX markets are going to move on chain just because of the programmability, the liquidity that is moving there, and euro being the number 2 traded currency, it makes sense if that it goes onto stablecoins, if that's in the FX space as well.
Yeah, I think there's a lot of things going on, kind of internally with the technology and what that can unlock. You know, you talk about efficiencies, capital efficiencies. You no longer have to wait. It can kind of reduce the cost of capital. There's a lot of things that are going on here. The programmability, that's a whole thing that we can talk about. There's also kind of macroeconomic things going on, like a competition for national or sovereign treasuries, things like this, that this technology can actually be used to unlock. And if I was a nation, if I was in charge of a nation, it's probably a good job that I'm not. I would definitely be looking at this and going, there's a major opportunity, just like how the US has put it forward. And they've been very kind of perhaps anti-CBDC, more promoting of stable coins, which, of course, we'll see if that's the right approach or not. And to come on to the Eurozone, which, of course, you operate within, do you think Europe can compete? I mean, you've just spoken there about how Europe isn't going to adopt the United States dollar. There is a kind of push away from a dollar-reliant system, and I think this technology can enable it. But do you think Europe can compete or stay competitive in this kind of transformation, perhaps from the money side or the treasury side, and have things like MiCA, which I believe actually came about in combatant of Libra? I think that was one of the main pushes
That was
for
the original. That was the burning platform in terms of creating a sense of urgency.
Yeah.
And then it started running really fast. No, indeed.
It's been going for a while now, MiCA. 6 years or so, right?
Yes, but there's still a grandfathering period that goes until June next year.
Okay.
So you see that there's still quite a lot of arbitrage going on in terms of delaying certain, let's say, compliance. We also see, and this is one of the battles, of course, that's happening at the EU, is the multi-issuer model. So you got whereas the ECB has the position that stablecoins that are fungible across regulatory jurisdictions shouldn't be allowed. Particularly USDC is being seen as a threat to, let's say, the ability of European businesses and consumers to redeem their stablecoins. Whereas the Commission seems to be a lot more relaxed about it. Says it will be fine. Don't worry about it, mate. And I think there's that part is an ongoing battle. I think it's probably the biggest one. I think, and has huge implications. So we're watching that one closely. Has huge implications either way, right? We believe that it shouldn't be allowed. We agree with the ECB. But then again, if it is allowed, then we can immediately see business opportunities to do it ourselves, right? Start issuing offshore, because it's much more profitable if you can issue your tokens offshore and then import them into the EU. You've got different rules around your reserve management. So anyway, so that's a temptation out there. I think MiCA is actually a very comprehensive, well thought out framework. It gets a lot of stick, but it recognizes stablecoins for what they are, which is basically e-money uh, with secondary market characteristics. So this is where the white paper comes in and the prospectus, and basically puts it into the CASP or the financial markets regulation as well to some extent. But it is e-money after all.
Yeah. Yeah. And how have you found all this as a stablecoin issuer? These are things that you directly have to contend with. You spoke about some pros and cons if certain things go forwards, and that's like many things in life. Often, there might be some negatives to things, but there's also opportunities with some of those shortcomings. How have you found all this as a stablecoin issuer within the EU? How has this been for you?
It's never really come up as something that frustrates us. I mean, obviously, dealing with regulators is always hard, and
Yes.
complying with regulations is always hard. And particularly as regulations become stricter and stricter, it becomes more expensive to do that. That will never change. I think that's you can add a death taxes and regulations to that in terms of things that you can be certain of. Now, we started our journey because we wanted to figure out how we can issue money on a public blockchain. This was quite a while ago, and we've always in the business of tokenizing stuff. We basically built a core banking platform where you can manage all kinds of tokenized assets as well as money. And every time we work with partners to create money on chain, it never got out of the lab, because just because you call a token a euro or a US dollar, it doesn't mean anything. Right? So it doesn't have any status. Tether achieved that because everybody believed, say, yes, it's a dollar. We all believe it's a dollar. Okay, let's work that. But if you're a new guy on the block, basically, why would anybody trust you for that? Right? So the solution that the company came up with is saying, well, we've got this e-money regulation that's has been out there for ages. EMIs have been out there for ages. Why not call it e-money and then go in discussion with the central bank or regulator and say, why can't we use a public blockchain as a database technology instead of a normal database technology? So that was the journey. And ultimately, after a couple of years, I think there was agreement was reached that you can actually do that. Then MiCA came in. But we were first and foremost an EMI rather than a stablecoin issuer. Now, if you think about the journey that EMIs have been through, 20 years ago in EMI, there was hardly any regulation. You could just do almost anything, just like stablecoins probably a couple of years ago. So you've gone through the journey of EMI. All the hard lessons in terms of consumer protection and regulation have been learned. I don't think it's reasonable to expect that just because you then have stable coins that say, oh, we're back to square one, we can do anything we want and innovate in whatever direction we want, right? It's just builds on top of it rather than it's a rebuild. So for us, I don't think MiCA actually creates that many new constraints that we aren't already dealing with. I think it's, but to comply because of the secondary markets nature, there's a few extra things that you need to do.
Yeah, and I think just if you could, there's a few questions that I've got just from that. There's always this debate between sort of public and private blockchains. I think one worry that I have, certainly for people that are into the crypto space, is that there's going to be the introduction of sort of private DLTs, and it's a question I always like to ask: why public distributed ledgers, public blockchains over private? Why do you think that battle, or what way do you think that battle goes? In your opinion,
It's always going to be public, to be honest.
Yes.
And
Yeah.
just because of the sheer cost benefits, running a private network is actually very expensive.
Yep.
And blockchain network. In my previous company, I did that, and Amazon fees were absolutely killing me.
Yeah.
So that's one reason. The second one is a lot of people don't look at. Even some blockchains can be considered private blockchains because the level of decentralization is too low. So you could arguably, let's say, Base, for instance, is a level to layer 2 blockchain, but there's not that many companies validating that network. So you could argue that if you are running your tokens on that, you're actually outsourcing to Coinbase, right? And if you start doing that, then suddenly you have, as a regulated financial institution, you need to have an outsourcing agreement with that party, right? And with outsourcing comes monitoring, comes a contract, comes SLAs, all that kind of stuff that's hugely important for business continuity. So I think that's one of the killers, that any company that uses the provider of a private network will need to have some form of outsourcing arrangement with that party, and that party may not be able to comply with the outsourcing requirements of the regulator. So I think I don't think it's trivial to set it up. Whereas if your network is very decentralized, there's no single party controlling it. The governance is decentralized. It's always up and running. There's no downtime. Then it's a very different story.
Yeah, I think in terms of reach as well, I think the internet when it first started did initially try and go down a private route. And then it kind of came to the conclusion that, look, if we want the global reach of this, if you want to kind of enable this internet of value, it needs to be sort of public, effectively. For the most part, anyway, I'm sure you're going to have private interaction. There's some things, although with pieces of technology like zero knowledge proofs and things, you can do all sorts of amazing things. And where would you say we are in regards to this kind of regulatory frontier within Europe? Do you think we're at a comprehensive point today where actually, like yourselves, you're going forward and advancing, or do you think there's still work that needs to be done? I mean, clearly this stuff can be done. You guys are living proof. Where do you think we are in regards to that? Do you think we're kind of there, or do you think there's still work that needs to be done?
I'm not sure we're there, but maybe for this iteration, I think there's quite a bit there, and I think the market should just enjoy or suffer through it, whichever way you look at it, for a while to let things stabilize and then do another iteration. It's a bit like if you're buying a house, an existing house, and you can, before you move in, you can do your renovation. So this is, I want to fix this, I want to fix that, stuff like that. Usually, I think though, if you're live in it for half year, you make completely different choices about what you're going to renovate based on priority. I think MiCA is a framework that's been well designed, well crafted, well thought out. We should live in it for a while and then figure out what we need to improve. I think the multi-issuer one is an aspect. I think potentially some of the reserve requirements, concentration risk requirements, are pretty tough for companies to adhere to. There's maybe enforcement could be a bit bigger. I mean, there's a whole section. There's a massive section of MiCA is about significant issuers, issuers that have more than 5 billion in circulation in the EU. To be honest, Tether, there's only two companies that can have that: Tether and Circle. Tether is not compliant in the EU, so we can ignore that one for now. Circle has more than 5 billion in circulation, but it doesn't look like the reserve requirements of a significant stablecoin are actually being met. At least I don't see it for USDC. I don't see any evidence of that. So that's an interesting one. So you can make a regulation, but then also at some point you should enforce it.
Yeah, and also continue to perhaps monitor it. I think one thing, we're talking about the kind of unlocks that this technology can bring for entire sovereign nations, certainly currencies. Yeah. You kind of don't want to stifle that, because I truly see this. We speak to a lot of people, certainly smaller countries. I think in some ways they can almost leapfrog some of the bigger countries. Of course, they're kind of Achilles to a degree, but if they use and utilize this technology, because a lot of the bureaucracy isn't there, they can kind of leapfrog in terms of having a more technologically savvy financial system, perhaps. A lot of the bigger nations that perhaps are a little bit more of an oil tanker turning rather than a speedboat, as it were. And I think one thing, I know we spoke about this last time you were on, I had mentioned the digital euro to you. And you do two things, as we've established, the kind of e-money side of things and then the stablecoin side of things. One of the biggest misconceptions, I think, in the crypto space right now is that the digital euro runs on distributed ledger technology. That is not the case, I don't believe. I know that speaking to central banks, they told me that, and I was kind of like, well, hang on, this is a huge misconception. How do you think that battle, if it is indeed a battle, plays out, the digital euro versus stable coins? Do you think the digital euro is a competitor to stable coins? Do you think, I mean, you'll be able to speak on this far better than most, you know? What do you think's going on there?
Well, I haven't seen the digital euro in real life yet, right? So I'm not.
Yes.
For me, it's also speculation. All I see is that every year that passes of this project, the timeline for implementation moves by a year as well.
Yeah.
So I'm not really looking at it from a. I'm not taking it serious as a as a as an as a player in the payment stack yet. I did hear that they were looking at DLT options because to put it on public blockchain instead of a centralized database, because the market was questioning why you're doing that. So I don't know what's happening with that direction. I think it's I don't know. Maybe I'm biased. Maybe I'm missing something. I think it's one of the most pointless projects that the EU is undertaking, and that
I've heard
it's
that before.
there's zero consumer demand for it. Yet we are expecting consumers to adopt it, and expect banks to spend up to 1 or 2 billion each bank just to be able to support it. It's just insane, right? So, and I'm not sure whether it's a real battle, whether the right battle is being fought there. But I'm very skeptical about it. It's basically like the EU decides to set up an EMI. Say, here you got some e-money. This is the maximum balance you can hold, and you can spend it at these and these places using this card that we issue for you. Right, so almost like that. And I don't think anybody's waiting for that. I think it's much. It just doesn't make sense. Anyway,
And why not just use stable coins?
Right? Yeah, we've got SEPA. It's very good. I know a point of sale. I think where Visa, MasterCard are very strong is at distribution at point of sale. Ideal, SEPA is not great at point of sale, so you still want to use that infrastructure. But to make the digital euro successful, you would need to deploy infrastructure at every single point of sale and enable the banks to support digital euros, do the authorization mechanism, all that kind of stuff. And I don't see any public party at the moment being interested in investing in that infrastructure unless there's proven demand, and the proven demand will take a while. So
I had to ask you that because I think some people are worried. First of all, some people believe this is going to happen on a public DLT, and whether they're exploring that or not is still to be seen. I know there is. Most central banks, certainly the ones that we've spoken to, they do or are looking at the implementation of distributed ledgers for wholesale CBDCs, which is a whole
that makes sense.
Kind of different thing. But the digital euro, which there's kind of some mysticism about, there's a lot of speculation about, so it's quite hard to sort of comment on things. But I absolutely agree, and it was sort of important for me to ask that because people worry about that sort of replacing what might be taking place on public DLTs, but there's so many issues with it.
It's complementary. You know? I mean, the way I look at it is, if I want to mint stablecoins, I'm reliant on the speed of the banking network for my customer to send me euros or dollars. Now, if they can do that way faster because we've got digital euro, great. Right, works for me. I also know that the digital euro is focused on retail, so I don't think wallets will be allowed to hold more than 3 or 4 grand or so. Which is completely not the stablecoin market in Europe. It doesn't make any sense. Stablecoin market in Europe is really focused on high value transactions, corporate treasury movements, cross-border payments, that kind of stuff. Not retail payments. So the two will live completely separately next to each other. So I don't see it as a problem at all.
Yeah, no, that's music to my ears. I know here in the UK, we'll come on to that in a little bit. We did get some sort of stablecoin guidance, as it were. I'm more interested in asking you in regards to the business kind of cap they've put on, not the retail one. I do want to come on to that for sure a little bit later on in the interview. One thing that you touched on there is how sort of stable coins are being used predominantly within Europe. It's more higher value transaction, cross-border payments, things like this. Maybe we'll go back a step and I'll just ask you what, as a stablecoin issuer, demand you're kind of seeing. Because I think the main role right now for stablecoins is still predominantly crypto trading. If you look at volumes and liquidity, it seems to be predominantly there and USDT denominated still. What kind of demand are you seeing for stablecoins at the moment? And I guess that's going to talk to your, or speak to your kind of business model and what it is you guys are trying to enable. You're there enabling that for a reason.
Yeah, sure. I mean, you can see emergence of some yield-bearing stablecoins in general
Yes.
that I think are very interesting, but they're not really stablecoins. They're just securities, dollar-denominated securities that you can move around easier. So if we focus on the stablecoins that are not yield-bearing, in my view, there's only one company that has built a successful business model on the back of stablecoins. The float that the stablecoins generate, and that's Tether. Nobody else comes close.
Yep.
Circle is number 2, but I think, and this is public information, I think they have to share most of the revenue they generate of their reserves with exchanges, with Coinbase,
Yep.
and others. So there's not actually that much profit left, at least not relative to USDT and to Tether. So then the question is, why would you do a stablecoin? And I think 2 years ago, people were rushing to the stablecoins. Hey, Tether makes so much money. We're going to stablecoin, therefore we're going to make so much money. I think that time has passed, and stablecoins are being increasingly recognized as a highly disruptive ingredient in treasury management. I think
Yes.
in the broadest sense, and most stablecoins may live only shortly. The ones that live longer are indeed in the crypto markets. And USDT is king globally. Nothing comes close, because that's where the network effects are, that's where the liquidity is. And USDC lives in Europe as a trading, but you've seen that most of the institutional traders who do the large volumes, they've already moved offshore long ago. So they're not trading in Europe. So that money isn't really here either. So it comes back to actual real world use cases around payments. And then where we see value of our stable coins is basically as a way to facilitate instant settlement with a third party. Right? I give you, I'm a customer. I need to pay a supplier, let's say in Hong Kong. I mint a stablecoin, USDQ or EuroQ, because I have an account with us, with Quantoz. I mint it and I send it to the other guy instantly, right? Done, settlement done, bypassing SWIFT, everything. Then there's the off ramp, and then you get into the question, okay, so, but how do I get liquidity in Hong Kong dollars, or how do I get liquidity in Colombian pesos from my token? And it's not there. It will never be. And so what I see happening is globally is that USDT is becoming almost like a settlement service as well, an FX service where you just need to build liquidity in the book of my token to. It's like a clearing. I need to make sure that my token, that there's a liquid book or there's good swapping capability to USDT, and then the rest will be taken care of by USDT. So one of the companies that we work with needs to pay a coffee exporter in Colombia, and they want to pay that person same day in Colombian pesos in their bank account in Colombia. There will never ever be liquidity in the USDQ Colombian peso book. I know that. Well, let's say never say never, but I'm not planning for it. But it's very easy to swap USDQ for USDT, and then there's a super liquid USDT Colombian peso book. And I think that's what's happening. Anecdotally, I hear as well that USDC is in cross-border payments is usually seen as an on-ramp to USDT. So again the float disappears. And that's for us as well. That's for us. For us, it's clear our destiny and our cross-border payments is as an on-ramp to USDT, and for European users, and as an off-ramp from USDT back into Europe. And so that's the use of our stablecoin in cross-border payments. Now, domestic users, we can see if corporate treasuries, they might prefer to have counterparty risk on us than on another party, because if you hold our stablecoin also as an international user, you hold it as part of your treasury, you need to be sure that you can reclaim it for money. And retail markets, they don't care about that, right? So whichever gives the most yield, whichever one is most liquid or gives the most reward points, whatever, that's the best one. In corporate markets, corporate supply chains is really around, okay, so what is the liquidity here? How do I get my money back if I need it? Then you start looking at jurisdiction, which regulator is looking after this? What are the rules of the regulation? Where's the money stored? Which banks are actually holding that money, right? So you're looking at counterparty risk, because if I accept as a supplier a payment in stablecoins, then the whole point of that is that I replace the counterparty risk that I have on my customer. I replace it with a much superior counterparty risk, right? That's when settlement takes place. And if you can do that on a Netherlands regulated EMI where funds are stored in systemically important banks, quite often that's a better counterparty risk proposal than the current banking service, right? So, and I think that's where, for treasury management, ultimately that's where I see our stablecoins being used as well.
Yeah, no, I love that take. I think reputation is certainly in this world when you're dealing with money, everything, right? If you think about why money works, there's definitely a belief element to it. And actually, if you can prove that kind of lineage via it being on chain, I think that's, it's a match made in heaven. I think.
Correct, and I think exactly, and this is where USDT is probably its only weak point, is that the counterparty risk is not necessarily clear. Where do I get it? Where do I exchange it for cash? On the other hand, there's so much of it, and it's so liquid that it doesn't actually matter. You can always exchange it. But for all the other ones, like us, it's different.
Yeah, but I think when certainly the first time I had you on, we spoke about your sort of systemically important banks that you were using and utilizing. Having the utilization of them, I think, brings a huge trust element. And I really love that point in regards to what kind of separates sort of good money from bad money, as it were, or trustable money from non-trustable money. And I think that's what this industry is kind of trying to do: introduce a trust element to everything. Do you see of any kind of catalysts perhaps propelling stablecoins? For example, if we look at stablecoins today, it's probably 95, 6, 7% dollar denominated. Do you see any catalysts to kind of propel the euro into more of a percentage? Do you see any kind of mainstream adoption catalysts coming down the line for stablecoins with euro? Because surely, I mean, how does this play out? Do we just forever live in a world where the dollar is the dominant stablecoin? Or is it more as people start to embrace this technology, it slowly loses market share? What do you think some of the catalysts behind that are and the future looks like around that?
Yeah, and I think it's what I mentioned earlier, right? So if there's a geopolitical increase in demand for euros, I think euro stablecoins will grow faster than euro acceptance, just because it's easier to move around and to access. It's the treasuries. As treasuries start, let's say one of the things at the moment is that holding stablecoins is a pain for CFOs, because it's not universally recognized as cash equivalent by the auditors. Right? So they see it as investments, which is another part of the balance sheet. So they need to redeem it always for cash. So if it can be treated as cash equivalent, then they can keep it in their treasury without having to without having to redeem it, which means that as more and more lives in secondary markets in corporate treasuries, the circulation will increase, particularly as the utility increases. A utility in this case comes from being able to move in and out of yield products instantly, intraday yield, through tokenized assets. I think that's a great use case, and that will drive adoption and reasons for people to keep euros in stablecoin form. But also the on-chain FX world that is growing very, very quickly. Because even now, if you do FX with a counterparty, with a broker, instead of your bank, you still lose it for a couple of days, right? It's T+2 settlement everywhere, whereas on-chain FX is instant, which is again remove settlement risk. So in general, I think, and then the third is supply chains, where euros are being used for settlement. It's not easy to do that if you're not on step out. So moving euros around the world is not as easy. So where we see stablecoins as a real game changer is in collapsing the settlement time to zero. If you, for instance, look at the commodity supply chains as an example, where I spent quite a bit of my time, most of them are denominated in US dollars, right? So it's but some of them may shift to euros because of geopolitical reasons. Now, if you're doing a shipment of, let's say, a shipment of coffee, and the goods get released by the seller the moment they receive money in the bank. So there's delivery versus payment, right? So now, if your settlement layer for the money is Swift, it might take 5 days for settlement to complete, particularly if currency is restricted, etc. So during those 5 days, what's happening is that the seller needs to hedge, most likely, their FX risk to their suppliers, because they need to pay their suppliers in local currency. They receive in US dollars for euros. So FX risk, you've got market risk, because the price of coffee might fluctuate during that period. So you need to hedge that risk. You face settlement risk in general. I mean, is the money going to arrive, or are the banks going to say, sorry, this is not compliant, we're going to send this money back? All that time, you're usually financing that cargo, so you're carrying, you've got interest expenses. So even though the payment through Swift might only cost $20 or so, the indirect costs are immense. Now, if you can bypass all that pain and have instant settlement through a stablecoin, bang, done. The deal's over, right? And all those indirect costs are gone as well. Now, that process is currently usually done in US dollars, because the only way money could move around the world efficiently was in US dollars through Swift. That might change to the euro as parties learn to speak a new language or want to speak a second language. That is less dependent on, let's say, the views of the day from the US administration.
Yeah, and I think if you look at the kind of repercussions that's going to have on the euro, certainly going to drive demand for it. And I think also one thing that's interesting is, if you look at the introduction of something like the shipping container, to us it seems it's a shipping container, right? We're kind of used to it. But there was a time when shipping was a nightmare. And then you introduced this kind of bit of technology. Actually, you saw something like a 600, 700% growth for shipping on the back end of the introduction of this technology. Do you think we could see some sort of bigger economical kind of growth or repercussions out of stablecoins being adopted? I mean, it seems in some regards small, because we're talking about stablecoins, we're talking about a relatively small industry, but the kind of repercussions for this being embraced, I think, could be huge. I think will be huge, in fact. What do you think about
that? It's very disruptive for business models as well, and unlocks it to. I think we mentioned it last time, indeed, as well. There's so much money locked up in Nostro accounts around the world. If you can move liquidity around, if you can move money around without having to and have instant payouts on the other side without needing to lock up money, that's already is a game changer. Frees up a lot of capital. If you can take the FX, all the hedging costs out of your transaction, that frees up capital. That can pass back to consumers. So you might even see pricing go the other way, or more margin, more profitability. But it also enables business models that we've seen happening in B2C, but not so much yet in B2B. So a lot of the innovation has been in B2C. You see global e-commerce platforms like Amazon selling to consumers, and there's almost instant delivery with all the logistics behind it, but also because the ways of payment have made that very, very simple. Merchants can get paid before they ship. Now, that is something that in the B2B world is still relatively new. So we see, so let's say if you have, I'll take the example again of a coffee exporter. That's because I love that example. Currently, the coffee exporter gets enough coffee beans together for a container, sells the container to a trader in Europe, and who subsequently distributes it to roasters at basically the small shops. The first transaction happens in US dollars. The second one happens in euros. Now, what if the exporter could actually hold stock in Europe and then do collections themselves, sell directly to the retailers, like drop shipping, B2B drop shipping? That requires more financial infrastructure to be able to do that, particularly collections, etc. And this is exactly what we're looking at. So we can help that exporter get foothold in Europe, do the collections from the roasters. So it's like maybe €1,000 or per transaction. And then as soon as it comes in, we mint it into stablecoins and send it back home. So you suddenly you can have instant payments, instant settlement globally, B2B supply chains, and that changes business models and the roles of intermediaries and the roles of parts of the infrastructure. And most of this can be done without banks, right?
Yep, which is the great thing, right? I suppose in some regards, I should say there's pros and cons to that.
Yeah. We still need the banks for instance, the fiat collections in Europe, but the repatriation offshore can be done much more cost efficiently. The banks, I think, also the banks like get a lot of stake. It's a misplaced conception that stablecoins are going to cut out the banks, because you actually don't want to cut out the banks. You want to team up with them because together you're stronger. We can do things on top of the banks, where the banks still capture transaction fee revenue, and we can deal with some of the customer-facing work and the innovation. Right? So it's actually quite a nice symbiosis.
And I do think there's a kind of stigma in crypto where because of where this industry came from, people are quite maybe anti-bank, anti-fiat. And I always like to introduce a little bit of a grey into that and say, actually, it's not all bad. You know, these things haven't all been bad. In fact, in many cases, having an elastic currency has worked for a lot of people. It hasn't for some. You know, I don't think that, and I think the space is kind of maturing in the sense that it's now looking at the kind of legacy systems, the banks, things like this, and going, okay, instead of replacing it, let's work with it and let's bring this technology for the embedment of not just early adopters, but everybody. And I think that's really something that, you know, I like to see taking place. I'm absolutely dying to ask you about what was announced here in the UK. It's amazing how many people I tell that I'm in the UK and they kind of go, "Oh, I'm really sorry about that," at this stage. But yeah, there was some stablecoin sort of guidance given by the Bank of England. Now there was a retail provision. I think it was it £10,000 in stable coins that retail is allowed to kind of hold, me and you in our personal wallets. But there was a proposed 10 million cap per business temporarily on systemic stablecoin holdings. What's your opinion on this bit of guidance by the Bank of England? Do you think it's good? Do you think it's bad? Do you think it's positive in the sense that they're actually taking this stuff seriously now? I mean, what's your general take on all of this?
Yeah, I think I made a comment in one of the publications on that one as well. I think it's very cautious, and I think it sort of misses the point as well. I mean, where is sterling being used in general? And I think retail payments, of course, is being used in England, but you don't need a stablecoin for that. Just like you don't need it in Europe. You got faster payments in the UK. Fantastic. I mean, there's nothing to fix there. Where you see stablecoins being very interesting is in cross-border payments, and then also particularly in the UK with all the funds and the asset managers, stuff like that, as a way to get much more efficient entry and exit from funds through tokenization. And for many corporates, that's going to be in excess of 10 million. And so if you're limited, you're basically cutting out that use case, which is probably one of the most promising for the UK. So that's why I think, not sure how long. It says temporary though, doesn't it, as a limit? So I'm not sure how long it's going to hold, and I don't really see why that's the issue. I think people are scared that stablecoins are going to replace money in society, which
to a degree, perhaps.
Which I find interesting, because if you do your regulation properly, and I think MiCA has done this, and Genius might do it as well, you always need to be one-to-one backed. So the stablecoin references money that already exists. You're not creating new money. As an EMI, we're not allowed to give credit, so we can't create stablecoins. We're not creating money, so we're not involved in credit. Now, if you see that, then the role of the banks is the credit, the money creation, right? You're putting money into the economy, and then the stablecoins reference the money that already exists. Now, I don't see how stablecoins can replace money that banks have already created. And if you're not giving yield either, then it doesn't replace the let's say
Underlying.
it doesn't make it more attractive to keep your money in stablecoins rather than interest-bearing deposits with the bank. So I don't know.
Yeah, I think
I was at the round table last week. Was organized by the Commonwealth.
okay.
Was the Commonwealth Enterprise and Investment Council. They hosted a round table in Mansion House, and it was very interesting discussion, very open discussion. I think in general, it felt that there was looking for ways. Hey, this is revolutionary. We recognize that this has a lot of potential. Now, how can we make the most of it? And I think that was clear as part of the discussion, very forward looking. So I hope that this regulation is more minutes from a meeting a couple of months ago, and that reality is catching up quickly, right? So.
I was just going to add to that. We spoke to some bankers in Croatia, and you talk about money evolving and becoming digital and on-chain and things like this. I didn't realize this. Maybe it sort of was ignorant to the kind of landscape of money. But in Croatia, it's still over 50% of cash transactions take place, and there's other countries within Europe that also adhere to that. I think Austria was one, for example. Perhaps Germany. It might have been Germany. It might not have been. So, and that kind of shocked me a little bit, because I was like, hang on, we're in this kind of internet digital enabled world. I know in my personal life, the majority, I never have cash on me here in England. It's all, but then again, whenever I go to Croatia, I spend a lot of time in Croatia, I spend a couple of months of the year there, and other countries in Europe. I'm always using cash. And it's like, and I think that I think stablecoins will play a role in retail, but it might not be an entire replacement. And I think the reason I think that is because cash hasn't been entirely replaced. In fact, it's still the dominant currency in a lot of European nations, which are very developed nations. So there's a consumer, I guess, what would be the right word, preference to consider also. And I think that it's always good to introduce adults back into the room, because I certainly get so glamorized with crypto. I think it's amazing, and it's going to do lots of wonderful things. And I do believe that. But there's limitations also.
And I think cash is a good example of money that lives in the secondary market. Utility is very high because of that reason. And one of the learnings is also dealing with corporates then, but nobody actually wants maybe a crypto trader wants a stable coin. That's how it was invented. But nobody
Yeah.
else really wants a stable coin. They want to be able to do a collection or for one of their clients. They may want to make they want to have excess yields, but they don't want a stable coin. Stable coin is just one of the ways to get in there. And same thing goes for consumers. I don't see anything. Consumers are well served. There's a lot of options: cash, electronic. I don't see anything that's going to entice the users to start using stablecoins unless they can get maybe a 5% discount on every transaction because the merchant
Yep.
makes so much more money. So it's
And what did you think about, sorry to interrupt you, yields on stablecoins? Because we know that this is a no-go. As far as I'm concerned, all the regulation has very much come out and said, look, you can't pass that yield. Let's say you are holding treasuries that are earning a yield. You can't pass that on to the stablecoin holders. What's your... And obviously the reasons for this, to my knowledge, is because that would be very disruptive to banking as we know it. I mean, it would... Then you perhaps would have a decentralized alternative to a lot of traditional banking systems, which would perhaps cause systemic risks. Is that perhaps why you think that's been sort of legislated in, that you can't pass yields on to stablecoin
I think
issues?
so. I
Yeah.
think it's an important aspect. I mean, we've had a really weird period where there was zero interest rates,
Yep.
or even negative. I think that's an abnormality. But normally, the function of banks in the economy is give credit, right? There's money
Yep.
creation, provide working capital to the economy, and loans and stuff like that. Now needs to be backed maybe 10% by deposits. How do you attract those deposits? You need to give some incentive, which is yield.
Yep.
So if stablecoins say, "Oh, hang on, I'll just put it in U.S. Treasury bonds and U.S. Treasuries, and I'll give you 4%, whereas in the bank I get 1%." That means, oh, let's give the money
Yep.
to the U.S. government instead of giving it to the banks that we need to create, basically to put fuel in our economy. So it makes complete sense not to do that, not to create this
100%.
on-chain competition for it. So
Yeah, and then you can end up with perhaps runs. You know, you talk about the fractionally reserved system. I mean, if it would be catastrophic, I think in many regards. I think it's interesting. You know, I've watched this space come from like algorithmically backed stable coins to money market issued stable, and it's all interesting where we are today. But I think progress is definitely being made. One thing I'm dying to ask you to sort of conclude is, where are you guys looking to go from here? You know, talking about the next 12 months, which is a long way out. Certainly in crypto, a lot can happen in 12 months. What's your focus at Quantoz, and what kind of things are you looking for to enable during the next sort of 12 months or so?
yeah, couple of things. So first of all, building out our core proposition, right? We've got a bit of we've got a fantastic technology stack that enables to take our proposition to market, but we still need to build a little bit of front end jazz to make that useful and usable for our corporate customers. So that's one. We want to the challenge with having money, issuing money, is that money is being used in everything. So you need to choose where you focus, and we're zooming in very much on collections in the EU for non-EU merchants from Hong Kong, from LATAM, from Southeast Asia, from Africa. How do we build those rails so you can receive a payment here from a customer in the EU into the account that merchant holds with us, and how do we get it as fast and cheap as possible back home? So that's really what we're focusing on for the next period, to get that done properly. And that has quite a few parts to it, including liquidity. So as we see more and more stablecoins coming out, every man and his dog is going to do a stablecoin, every corporate. The question is why, and how do you deal with that world? And again, for us, it's recognizing that although stablecoins are going to live together, but ultimately, if you want to make them useful, you need to tap into liquidity in secondary markets. Otherwise, you might as well use e-money, right? So the reason for using stablecoins is secondary markets, where you can off-ramp easily into fiat in another jurisdiction, into another asset. So building zero slippage liquidity with, for instance, USDT is for us a key unlock. And obviously, we as a company, we're quite close to Tether. So we like working with them precisely on that concept. And I think that's one of our key deliverables for the year. And of course, like every startup, we need to make sure we've got enough capital. So there'll be some fundraising activities that we're doing now and probably next year as well. So there's still quite a few things to do there.
Yeah, it's going to be a busy 12 months. Yep, sorry.
But longer term, I think the global, if you look at imports into the EU, it's a massive market, a couple of trillion euros. Almost nothing is done in stablecoins at the moment. And it's a huge space to grow, and I'm very excited to see how we can make traction there and what we encounter, what we learn. So it's cool. It's one of the best spaces to be at the moment. And I think if you look at where a lot of the attention goes out at the moment, it's stablecoin issuers, it's stablecoin infra, it's e-money or neo banks for corporates. We're doing exactly those three things. So it's just a matter of retaining focus and executing.
Fantastic. I'm really looking forward to, I've been watching your journey thus far. I'm looking forward to seeing it move forward, certainly in such an impactful industry, and the role that you play, I think, is a really necessary one and part of the broader evolution that's taking place. Arnound, it's been an absolute pleasure to have you on once again. This has been really insightful for me listening, and I want to just say a massive thank you for your time on behalf of myself and my audience. Thank you very much.
You're very welcome. Really enjoyed it again. So don't hesitate to call me back.
Fantastic. That's it from us, guys. We'll see you on the next podcast.